Hello and welcome to Commodity Risk and Finance Online. This session is Chokepoints and Checklists, Managing APAC Risk in a Fragmented Market. My name is Ian Hiscock and I'll be the moderator for this session. Spent about 15 years in the mining metals, chems, ferts industry, initially in London and then in Asia. I'm delighted to be joined by Adrian from KZ Trading and Suraj Aggarwal from Dreymoor Fertilizers. Adrian, can you please introduce yourself briefly?
All right, sure. Good afternoon to all the EU participants and everyone from the Asia and the Middle East market. And good afternoon to you. My name is Adrian as introduced from KZ Trading Singapore. We are part of the Korea Zinc Group in HQ in Korea. We trade aluminium, lead, and zinc and distribute them to Asia, the Southeast Asia, and the Middle East market. Personally, I have experience in the risk management in both the soft and metals commodities. And earlier this year, I also had the opportunities to join a panel in Singapore Commodities Week regarding third-party counterparties risk management, and also as an AI as an enabler for risk management. And thankful to the Commodities Week organizer for this opportunity again today to speak with another seasoned speaker like Suraj and Ian for the today topic on regulatory points. Thank you.
Thanks, Adrian. Over to you, Suraj.
Hi, everyone. I'm Suraj Aggarwal. I'm the Group CFO of Dreymoor Fertilizers. Dreymoor is one of the top fertilizer player globally. We buy fertilizer from over 30 countries. We sell to over 55 countries, and we deal with over 300 counterparties. Before I joined Dreymoor in 2017, I worked for over 2 decades in commodity finance at leading banks like SocGen, ICICI, Citi, Standard Chartered. That's about me.
Many thanks, Suraj. So I think we'll dive into the schedule for today, and we're going to kick off with talking about geopolitical tensions and regulations and their impact on trading companies. So maybe starting with you, Suraj, how is commodity trading being disrupted by geopolitical tensions, regulations, many of the other things that were going on in the region, such as export bans, tariff sanctions, etc.?
Sure, very pertinent, question, given how uncertain the world is right now. So I'll tackle this question from the perspective of giving some examples. Let me take the first example, which is European Union has put tariffs on Russian products coming to EU starting 1st July 2025. Now, EU has always been a natural destination for Russian products for many, many decades due to favorable logistics, freight rates, but now it's becoming uncompetitive. So that's one big disruption between EU and Russian trade. Second is India and China trade. So China has been a big exporter of fertilizers to India, and India is the world's leading importer of fertilizers globally. And because of the geopolitical tensions between the two countries, China had put some sort of informal embargo on exports of fertilizers to India, particularly urea, which is a very socio-politically sensitive product for India. And because of which the prices of urea had shot up over the last 1.5 years. Another example is EU has put this CBAM, which is a carbon border adjustment mechanism, which is going to be taking effect from 1st Jan 2026. And this is taxing, putting a carbon tax on non-EU manufacturers of, let's say, fertilizer, producers. And for some factories and producers, we know the tax can be as high as $100 per ton, which means it cannot sell to EU anymore. Another example would be in April this year, US had introduced a fee for Chinese vessels entering US for loading or discharge. And on 10th of October, which is last Friday, China has introduced reciprocal fees for US-owned or American-owned vessels entering China. We hope that they both retreat from their tough positioning, but if they don't, this has really how you say this can trigger a massive issue with respect to US-China trades, as well as freight rates can shoot over the roof if this goes into implementation. Yeah, so these are some of the examples, how geopolitical tension is leading to disruptions in the trade and the commodity flows.
Great. Many thanks, Suraj. And over to Adrian. Do you have anything to add on the metal side? How's geopolitical tensions that disrupting commodity trade flows and prices?
Yes, I think it's just adding on to the long list of what Suraj has said. I think like for Indonesia, we can see for years they have been banning nickel export out from Indonesia to the overseas countries, and also we can see recently iron ore space. The China is not stopping, or the Australia iron ore into China as well in the news. So these are so much things has changed. But earlier this year, I believe many of the trading companies are still adopting a wait and see approach, as policies are still unclear, ever changing, and new revised regulation have deadlines to meet or removed at the last minute. I think we heard of this famous headline news, which is taco trade, which is Trump always chicken out. So things always change and back and forth, and things are just giving us an unstable environment for the trading companies and also other companies that's trading around the world. And if our company or the trading companies are still unable to adopt to this new regulatory environment, I think the thing is that you will be left behind. So this is what we need to be aware of.
And I also hear you're very interested in sanctions, Adrian. Are you able to tell us something about that?
Yeah, sure. I think sanction is definitely, I believe, is already in a mature environment. You can see that a lot of companies, when they deal with a new counterparty, sanction is always a pre-check for our KYC onboarding procedure. However, I think through our partners, we do notice that, like, for example, like recently, 1st of October, there's new regulation update. Example, like Bureau of the Industry Security from the USA. They have a 50% ruling which say that which covers any overseas entities on their export regulation, which also means that stringent check on not just on sanction or the AML kind of things that you need to be aware. The ultimate beneficiary owners are now also required to be able to be ascertained, to able to fulfill whether you are breaching the 50% rules. And this is some kind of new development in the regulatory environment, that we keep having this kind of a new information coming into us.
I'm sure that will be very useful for our audience. We're going to take a quick pause and poll for the audience. So the audience should be able to fill out this little questionnaire. And the question is, what's your company's main strategy for managing fragmentation and uncertainty in APAC markets? Is it increasing use of data and analytics, strengthening compliance and due diligence, relocating or restructuring operations, waiting for regulatory clarity? We will get back to you with the results of that poll and switch to a relevant question for the panelists around APAC being a uniquely diverse region, fragmentary regulatory regimes. What's the cost of dealing with this fragmentation? Suraj, do you want to take that one first?
No, let Adrian take it, because he has more experience of selling metals in the APAC region, so I think he'll be better placed.
Okay, back to you, Adrian, then.
Sure. I think just a very good example for ourselves is the metal business. Recently, our products, which is required by the Bureau of India standard to be certified to meet the minimum standard or quality standard, which is requires certification. So one of our products that we have used to be importing to India for the past 3 years did not meet this requirement. And therefore, we have to stop ship anything before this the deadline requirement by the Bureau of India Standard. And for the next year, we have to find alternative market or exit the sales entirely. So this has put us in additional cost to get certified and disrupted our business directly. But besides from there, we do see that this from this situation, we do see that there's high volatility in supply and demands affects our commodity price and premium as and when there's new regulation implemented. So before this before the regulation implementation, the trade arbitrage to this area often occurs, and we face period of high premium, high price. And also, for example, like we recently hear of the tariff on copper that is importing to USA. So we do see a USA, the CME price and other LME price exchange creating a huge market spread. So this kind of disparity have given some traders to make extreme profit and some traders who is wait and see to be left out of the market participation.
Thanks, Adrian. Very interesting answer. And maybe we can have a quick look at the poll results so far. So what's your company's main strategy for managing fragmentation, uncertainty in APAC markets? And 67% of the audience have come back with waiting for regulatory clarity. And that's shortly followed by increasing use of data and analytics. Any comments or thoughts on that, Adrian or Suraj?
No, I think this is as expected, right? Regulatory environment is changing so rapidly. What is the rule yesterday is no longer the rule today. So, I think most of the companies are waiting for some sort of a stable environment where predictability is high and uncertainty is low. And I think the US is going to lead by the example, right? Where they are causing the major disruption right now by having every day a new stand. So let's hope that a clarity emerges.
Yeah.
Yeah, I think same thing. We're still waiting for the wait and see approach as what clearly a lot of the participants has answered for us. And of course, we also wait whether it's still a taco trade or taco comment from the regulations.
Good stuff. Well, wonderful. I think that wraps up the part on regulations, and we're going to switch gears slightly into risk management. So how are regulations and volatility affecting risk, things like liquidity risk and concentration risk? And I think I'll go to you first, Suraj, on that.
I mean, we all know that liquidity risks have increased because commodity prices are very volatile. But thankfully, commodity players have far stronger balance sheets now due to super abnormal profits, which happened during COVID era. And obviously, with that comes better ability to manage such risks. From our perspective, we are doing certain things to handle our liquidity risk better. We are diversifying our banking pool to onboard home market banks, which was missing before, especially banks from Asia and Middle East. We also started working, like many other commodity players, with alternate capital financiers to leverage technology and trim balance sheet. On capital side, we increased the percentage to 20% of our capital for risk management. And we are making sure that 25% of our banking lines remain unutilized at any point in time. We capped our debt equity to 1:1, which is extremely conservative for a trading company. And we also cut down on the long working capital cycle businesses. So, we believe after having seen, these cycles, which are coming very frequently nowadays, is better to be conservative and have that bit of inefficiency in capital usage instead of facing a liquidity crunch, especially when the volatility is very high and losing hard-earned reputation. Because it takes only one trade to go bad for you to lose the reputation which you have built over so many years.
Yes.
So conscious call taken, despite the fact that cost of capital is highest today over the last 10 years. We took that call. In terms of concentration risk, I mean, long before tariff, we learned our lessons during COVID, and we developed our decentralization and diversification strategy to absorb shocks and mitigate impacts of uncertain, uncontrollable external events. So we basically decentralize our decision-making processes. We de-regionalize the trading centers for them to have better access to real-time information, which can help in better, and fast decision-making processes. We change our incentive models, use top-down approach to give massive push to business and trade diversification. So yeah, these are some of the things we did to manage liquidity and concentration risk.
And what are some of the pros and cons of diversifying who you buy and sell to?
I mean, from our perspective, what we can say is that over the last 5 years, we engage in a massive diversification push, right? Both in terms of, like you rightly said, suppliers, so origins, as well as destinations, so customers. In fact, our number of suppliers more than doubled, number of customers more than tripled. Our top 3 suppliers and top 3 customers contribute now much lesser to our overall business volume than what they used to do earlier. Our top 10 countries, origin and destinations have also quite significantly reduced. So we have achieved what we wanted to achieve. In fact, US, for example, today forms less than 1% of our business. So the pros obviously is that you are having a reduced dependency and you have more options. So you can switch, you can at any point in time for the same product, you have multiple destinations, multiple customers. Similarly, for the same customer order, you have multiple origins and multiple suppliers to choose from. So that gives you massive operational flexibility and efficiency. In terms of cons, it does take a toll on margin. So you have to compromise on the margin and have a play which is more a volume play and more reasonable profitability kind of a scenario.
Yeah, many thanks, Suraj. That's some very interesting food for thought there. Adrian, do you have any comments on diversification and concentration risk?
Yeah, definitely. I think not to repeat what Suraj has said about all these financing management. I think for ourselves as a trading company, we also be more stringent on our payment overdues case. So we manage our customer overdues to maintain our working capital cycle. And earlier we mentioned about the high premium, high price in this uncertain environment. So it's really require a high working capital level of financing our trading business. So a lack of supply will definitely make the market more competitive and the high price purchase. So for companies who is, I think as a risk management point of view, for companies holding inventories who is unable to export to affected destination, we do see an increase in your holding cost by storing your inventories, and also if your product is hedged, you definitely face a backwardation market curve at this point of time, and also there will be paper position on margin calls and nearby position in this very tight situation. So I guess like what Suraj has said, maintaining a high capital level to make sure that you are able to buffer this kind of situation, like what we see previously a few years ago about nickel crisis, where margin call has been going through the roof on the volatility, like $100,000 for nickel price. I think that's where we should be still maintaining this kind of buffer in place. And also to get back to your question on the diversification of our customer, I think not just customer diversification. For our business, traditionally we focus on zinc trading, but actually we now diversify our trading products to aluminum, lead, and copper, so that we can explore new countries and new jurisdiction to diversify into high value market area for this kind of difficult business environment. So, and also after the tariff in situation, I think a lot of and also the certification requirement for our India business, we do see that we need to be able to diversify out of the region. Out from Southeast Asia, we see a slowdown because of tariff implementations.
Thanks, Adrian. And maybe some follow-ups there around our traditional risk assessment models keeping up with counterparty risk and fraud prevention.
For me or for Adrian? I take it?
Go ahead. Yes, yeah, you can take it, of course. Yeah.
See, the world has seen significant supply shocks and definitely greater counterparty risks due to pandemic, war, geopolitical tensions, currencies volatility, sanctions, Red Sea attacks. Commodity industry in particular has witnessed increased instances of contractual breaches, in our opinion. What we hear from, even COFAs, Euler Hermes, Acadius, and other market participants. While some were due to counterparties' inability to perform, rest were purely because of unwillingness to respect the contractual obligations, either due to unfavorable price or currency movement. Because domestic currencies, especially in Latin America, in some of the African countries, have been very, very volatile against US dollar, since beginning of the year. So that has led to some pain, with the customers in those geographies. As a response, we modified our in-house developed risk model, and we also de-regionalized, as I spoke about before, our trading centers. Our risk model now gives much more weightage to non-technical factors such as quality and stability of the management, past breaches, domestic country currency volatility, domestic country foreign currency exchange reserves, currency controls, domestic banking system, access to liquidity, with the top 5 banks, of the country of destination. Even on technical analysis, we introduced some new factors, like real cash flow from operations, breakdown of receivables, payables to see how much is trader to trader dealings, which is obviously a sign of alarm. Then stocks aging, these kind of things. And the best part is that our in-house developed model, which costed us actually $2 million, which is quite a lot of money. It gives more weightage to non-technical factors when the price and or currency volatility increases. So it gives more weightage to non-technical factors during those times than giving more weightage to the technical factors.
And that's because there's more likely to be a breach of contract. Is that, did I understand that correctly?
Yes, that's right.
Yeah. Fascinating. Adrian, any follow-ups on that? Anything from the metals world?
Sure. I think for us as a our traditional KYC approach, like onboarding which is performing once at the beginning of the business relationship, has stopped. So we actually have to have more partnership with a lot of our credit agencies, the insurance companies coverage, and subscribe to system like the LSEC World Check to enable us to do like ongoing screening and monitoring of our counterparty risk. And recently, we are even discussing on our capabilities to have real-time check on the ultimate beneficiary owners to be able to be compliance ready. Kind of more and more resources has to be deployed in terms of managing our traditional risk model, in addition to what we have been doing in the past.
Yeah. And do you have any comments on how sales and operation planning is being disrupted?
Yes, definitely. I think what we always used to do is sales and operational planning is like a monthly budget and forecast discussion. We have a yearly budget forecast revised every 3 months. From now, it becomes a real-time discussion. Opportunities come every day. Or every weekend, you see a new regulation change. There's always opportunities for the trading company, not just on the risk management, but actually, if you are a trading company, your role is actually to take on risk for the big players. So definitely, I think for sales and operational training is operation discussion has always now become a real-time basis discussion to be not left behind in this regulatory race.
Yeah. Anything more to add on that, Suraj, or?
No, I think Adrian has spoken aptly and described, sufficiently that no longer you can have MIS for 1 year or a budget of 1 year or even 2 years. You have to have more real-time discussions nowadays, and you need to be flexible in your modeling, in your sales numbers, in your targets, in your profitability numbers. Because things are changing so fast.
Yeah. Fantastic. All right. Well, I think that wraps up the risk management part of this session. And to leave some time for audience questions at the end, let's move on to commercial impact. So I think starting with yourself, Suraj, let's perhaps talk about what are the key risks and opportunities for trading companies. Is compliance a competitive edge, or just a cost of survival?
See, US tariff introduction was a big disrupting event. We all agree, and there's no denial. It has led to massive upheaval in the supply chains and the trading patterns and the trade flows, especially commodity trade flows. And it directly led to higher counterparty risks because of the increased FX volatility.
Yeah.
Undoubtedly, trade risks have increased manyfold for trading companies like ours due to ever-changing regulatory landscape, geopolitical dynamics, ever-changing, sanctions, framework. But it's a blessing in disguise, because for the good and smart traders who thrive in risky environment, higher risks means better margins. And that also means lesser competition, because you are able to manage risks properly. Not everybody is able to do it, right? You need to have a certain size, certain expertise to manage these risks, which are changing almost on a daily basis. For example, let's say, Adrian talked about Indian BIS system, certification system changing overnight, and suddenly Japanese product is no longer allowed to go to India unless you go for the recertification, right? But as a trader, do you have a possibility, because you've already bought most likely the product, right? And now your market is gone. Do you have the flexibility and ability to divert that product to some other market without losing money, right? And it can happen on the other side, right? So for example, let's say the supply side, there's a problem. Let's say you are a rare earth exporter from China, you can no longer export to US. Let's say, for example, to an arms manufacturer or defense, company. Are you able to supply somewhere else? Do you have a ready market? Do you have ready customers? So I think people like us who are managing the risks better will have good years ahead.
Wonderful. Good, optimistic, positive note there from Suraj. Adrian, any thoughts on these questions?
Yeah, and just to add on, I think as mentioned earlier, our existence as a trading companies to take on a bit more risk than the usual commodities operation. And we see more trades activities from this big producer moving to trading firms so that they can actually move things faster than what they used to do when the regulatory change. So I think we are here to make the decision quicker in trade as a trading company, but also mindful not to cross the regulatory boundaries and invest in compliance advisory with legal trade expertise and also some of the risk system which will keep you up to date to be ready.
Good. And who are going to be the winners and losers of this disruption?
I mean, I think it's the doomsday for niche players. Unless things become back to normal, which Trump being Trump is highly unlikely. So players who are dependent on a specific origin or a specific supplier or a specific destination or a specific customer, those people, those customers, I mean, those companies, those traders will find it very, very hard to survive in this environment. But for us, companies which are truly global in nature, who are buying from everywhere, selling to everywhere, who have multiple customers, multiple suppliers at any point in time for the same product, it's a great opportunity, to make more money and also capture more market share. So global agile players will thrive, in my opinion, in this market. And the proof is very simple. If you see a player like us, or take any global player who's a market leader in its segment, the top 3, top 5 market players, they all having higher volumes post this tariffs introduction. They are all having better margins, this year compared to last year. From our side, we are also using this opportunity to do forward integration and invest in supply chain assets, because we still believe that there is an arbitrage between local market price and the global prices in certain segments, especially during the peak season, which I think we would like to capture by having these supply chain assets in destination markets. And we are investing heavily in supply chain assets building in Brazil, and will be in the next maybe 2 years amongst top 5 distributors of fertilizers in Brazil. So it's also time, for the big boys to invest and be future ready, because they will have to do more, because niche players are going to disappear.
Is supply chain assets, is that storage, or is that all the way to production?
No, so we were not doing backward integration, so no production. But yes, small processing, facilities, as well as warehousing.
Yeah, got it. Over to you, Adrian. Any thoughts on the winners and losers, and any other thoughts around how trading companies will make the most of the opportunities that are presenting themselves?
I think in my personal opinion, like the losers will definitely be those that is still in the wait and see mode, while the winners are those who have the resources. Like example, they have strategic partners, suppliers. They are shipping lines that are able to move things to them by diverting cargo on the ship from Southeast Asia to the US region, like in 1 or 2 days instruction. I think those with good liquidities, maintaining the high margin call, and also the compliance-ready trading firm will definitely be benefiting from any arbitrage opportunities in this volatility environment.
And I know you previously worked for a big producing company. Are there any differences between how traders think about it and how producers think about risk and opportunities? Will trading companies take a larger market share, and producers back off from plans to expand trading activities?
To be honest, I have left the producer industry for a number of years. But as what I used to understand is that the producers are still conservative in terms of trading. I think any compliance issue is always holding them back from doing a big step to get bigger margin than traditional trading house. Like if we mention a few names like Trafigura, Mercurial, who has reported in the news 300 million from just the metals business alone this year. So I think we can see the big difference between the mining company, who is now subjected to a lot of regulatory, political environment, whereby countries are stopping the trade flows directly, and then the trading company who has all these agile criteria or resources that we have mentioned by Suraj and myself in this forum, that being able to have all these strategic partnership will allows you to be more ahead of the traditional resource producers.
Yeah, and if I can add here,
of course.
In fertilizer space, all these big producers, they thought that, traders are making a lot of money. which they shouldn't be making because it's an easy business, simple business. And all these producers started to go directly to the customers. They set up their destination, distribution arms in big countries, and they started to, poach the customers which we were selling to. Because customers are known, right? I mean, because the bill of lading mentioned the customer name, which is shared with the producer. So they all tried to go directly and save those, make those extra few dollars. And guess what happened, in the last few years, because see, producers are always long, right? By definition, they're always long. Traders don't need to be long always. I'm sometimes short, I'm sometimes long, depends on the market, situation and my view of how the market is going to behave, right? So that agility producer doesn't have. Remember, producer has a limited warehousing capacity. Producer doesn't want to shut down the factory. It never wants to have the headline news that, oh, the factory is shut down for 1 month because the prices are down and the warehouse capacity has been full, right? Producer will always have that compulsion of moving the product. Always. They cannot stop that. A lot of reasons. We don't want to get into those reasons, but that's a compulsion, which trader doesn't have. I can sit tight for 1 month, do not do any business. I'm okay with it. They cannot do that. So producers, trying to take this easy margin of traders and going to destination countries, they all have burned their hands, fingers, other vital organs, and lost massive money, millions, billions they lost, because fundamentally their business model is very different from a trader business model. A trader, in my opinion, no matter how big or small, is far better place to manage risks in the trade compared to a standalone producer. And producer cannot buy from other people, right? Producer will always only buy, even if they set up a trading arm, the trading arm will only buy from the same factory. They will never buy from other factories, right? So, there are sensitive issues, plus their simple inability to manage the market risks is so pathetic that they always lose money. But good for us, because when they lose money, they retreat, and our margin increase because now they need us more, because they've already burned their hands. And the reason why we are going so big in Brazil is because most of the producers who had set up the distribution arms in Brazil have left because they lost a massive amount of money. In fact, right now, as we speak, we have 2 producers wanting to sell their business to us. So producers risk, I mean, in my opinion, we don't see them as a competitor. If at all, they will go, they will lose some money, and then we go, and capture the market share.
So if I understand you correctly, there's perhaps 2 things here. There's one that the trading companies, it's in their DNA to manage risk, whereas producers are a very different business model. And then the second bit is that flexibility and agility to be long, short, and do nothing. Is that right?
Yeah, I mean, imagine, for example, a Russian producer. Let's say the producer was selling to Europe, right? They signed a contract, and now suddenly European Union has put a tariff, which they have, by the way. Now, what the producer is going to do? He cannot supply. He will not buy from others. He will not even know how to buy from others. I can do it. I can sell that Russian product to somewhere else, which I have done it, and I can buy some other product and sell to Europe. So I do not lose my supplier. I do not lose my customer. I just match make them with different other counterparties, which a producer can never do.
Got it. Adrian, anything to add into this conversation?
No, I think Suraj gave a very good example. I think that's why the trading companies, we are there to take the risk. And of course, the producer, they might not even hedge their produce. They just sell it at the market price. So like for us, we definitely manage price risk, trading risk, market risk on a day-to-day basis, monitoring the regulatory environment. Like we read the news every day just to keep ourselves ahead of the game. So this is where we are always ahead of the channel.
Okay. Well, thank you both very much. It's been a fascinating discussion. We'll just have a little look to see if there's any questions in the chat. There's no questions from the audience. I think we'll wrap up here just a few minutes ahead of time. So thank you both, Adrian and Suraj. It's been a real pleasure speaking with you, and everyone who dialed into this. I hope you enjoyed this session, and we look forward to speaking with you in the future.